The housing crash was just canceled. We're going to talk about that and more. Hey, everybody, you're watching Bull, Boom, Bear, Bust. My name is JJ, back with another dose of economic reality. So, we've got to talk about home prices. We're going to tie it in with the rest of the economic situation here as we continue to go into this slow motion economic collapse. Now, it doesn't seem like it because we're not really seeing crashing prices like you would expect in an economic collapse. In fact, prices are still going up for some things. We're going to talk about real estate here and the reason why, one of the reasons why home prices are not crashing. In fact, home prices actually just took another notch higher if you look at year over year numbers. So we're going to get into that. First, let's go right here to this article and take a look at this. They want to keep the housing bubble inflated. The U.S., and this is out of Bloomberg, the U.S. is backing $1 million mortgages now in more cities. In other words, the government, FHA loans, are backing higher priced properties. If you wanted inflation to come down, if you wanted home prices to come down, the cost of living to come down, would you want to back bigger mortgages, or would you want to drop that and back smaller mortgages, or not even back them at all? If you really wanted prices to come down, you could say, okay, we're the government, we're not going to back any more mortgages at all. The government doesn't need to be involved. But instead of not being involved at all, they're involved and they're increasing the amount of mortgages that they're going to back. So this is going to have another inflationary force in the housing market. So people often wonder why home prices aren't crashing. And remember, I was one of the only channels here that told you that the housing market was not going to crash. Yes, we're going to see a correction. We're going to see a correction, and we are, but it's very slow motion. We did see the year over year numbers dip recently, but now if you look at the recent numbers, they're up again here. Let's go to another article here. Home prices hit another record here. This is out of Yahoo Finance. Hit another record high in September despite higher mortgage rates. Now, to be fair, they are looking at year over year numbers. If you compare home prices to the peak, which was back in the summer of this year, then prices technically are down. So they say record high year over year. That's true, but home prices actually are not at a record high on a relative level here. The index tracking home sale prices in the U.S. cities, the 20 largest cities, gained 0.7% in September from August, just missing the 0.8% increase economists polled by Bloomberg. The index rose 3.9% compared to last September. So that's the big number that they're looking at. But if you go back to June, July, prices are actually down in just about every one of these cities that are tracked in the Case-Shiller index. So this is very important for you to think about, for us to think about. If the powers that be wanted the cost of living to come down, you have to look at housing. That's the biggest expense that people have, most people anyways, unless you're living, free somewhere with your parents or something. But most people, the biggest expense is their rent, it's their mortgage, it's housing by a large amount. The second biggest, I believe, would be automobile payments and upkeep and insurance and all that. But yes, housing. So if you wanted the cost of living to come down, aka inflation. Now, when people hear inflation, sometimes they think about the money supply. Well, financial people do often correlate inflation with just meaning the money supply. But if you just ask most people, they think inflation is what they pay at the grocery store. If you ask, I think 99 out of 100 just people, not financial gurus, but just people that you meet, you're going to find that most people would state that inflation is their cost of living and what they're paying for goods and services. And if you look at what people are paying, housing is number one. It's the biggest expense. And now a quick word from our sponsor. Dark clouds are gathering as markets shudder. Stocks are sinking, currencies stumbling. Fear and uncertainty reign. The Middle East, Ukraine, Taiwan, the debt, it's endless. Yet one asset stands firm, gold. In crisis after crisis, gold is there in the background. Its enduring value guards against loss like a missile shield against incoming. While paper wealth burns, gold persists. Shield your savings against looming threats, war, recession, contagion, and avoid the frenzied panic of the unprepared. Take control in the chaos. Fortune favors decisive action. Get hold of gold now before it's out of reach. Right now, Noble Gold Investments offers a free 5-ounce America the Beautiful coin with every new IRA. Claim your free coin today to secure your financial future. As this new storm gathers, panic looms, and some of the places you were thinking for your money, well, they don't look so clever anymore. Secure your future against disaster. Open a Noble Gold Investments IRA and claim your free bullion coin today. Go to noblegoldinvestments.com now. noblegoldinvestments.com, the only company I trust. Link down in the description of this video and in the pinned comment. So why not try to bring down home prices? Why not let the cost of housing come down? Why do we have the government out there increasing the amount that they're going to back on these mortgages? It's absolutely insane. It goes against everything that they're actually telling us that they're trying to do. So I'll let you figure the reason out, figure that reason out. I think it's because, and I know this actually, housing, when housing goes, the economy goes. And the last thing they want to do is have a housing crash here, less than a year until we make the new selection next year, November of next year, which really is not going to make much difference. People are starting to message me again now. Who are you for? Who do you think is going to help the economy? Folks, let me just say this one time and we're going to move on. Replacing a politician with another politician is not going to change it. The whole system has to implode. We have to see a massive crash or collapse in the current economy in order for there to be a reason to kind of restructure this whole financial system. So until that happens, I don't think any politician changes or exchanges or replacements are going to really make that much of a difference. Yeah, some here and there, but the big picture, not much at all. Well, let's transition a little bit. Let's talk about this. Not only do we have more propping up of the housing market, we have now the Fed, and people at the Fed talking about rate cuts. This is absolutely insane how they would actually start talking about this. Fed's Waller raises possibility of rate cuts by spring. What did we tell you just a few reports ago? Fed's Waller raises possibility of rate cuts if inflation keeps slowing. And what do they mean by slowing inflation? Do they mean the cost of living coming down? No, they mean the cost of living still going up, just at a slower pace. So inflation could get worse, meaning prices are still going up, just not as bad as they were. And they're going to use that as a reason to cut rates. A key Fed Reserve official raised the possibility that the Fed could decide to cut its benchmark interest rate as early as spring if inflation keeps declining steadily. Now, maybe he is the outlier, amongst that group there. Maybe the other people at the institution there do not agree with him. But the fact that he's saying this, and this is the Fed's Waller, so this is one of the key guys there at the central bank saying rate cuts. Why are we even talking about rate cuts when look at what's happening with consumers right now? And just to remind people, let's just go through a few of these articles here. Credit card balances see the largest yearly leap on record. So if consumers were so strong and resilient, why are we breaking records at the amount of credit card debt we're accumulating as consumers here in the U.S.? Another sign here of the consumer. Auto loan delinquencies reach record high. And this is out of money. So is that a good sign? Is the consumer resilient? Auto loan delinquencies reach a record high. Mortgage delinquencies on the increase in the third quarter, even with home prices still going up for the most part. Still more delinquencies. So people are running out of options as far as replacing their savings. Remember, savings has plunged towards a 40-year low. And one of the biggest things people used to be able to do was take equity out of their home. Well, now we see people raiding their 401k, draining their retirement and savings accounts. And the lifeline, which for a lot of people is the home refinancing and cash out refis. With the higher interest rates, that lifeline is gone. So naturally, delinquencies are increasing. Now, it's not at a record high yet like automobile loans, but ultimately, it's going to have to get to that point where we're going to see record high delinquencies way past the 2007, 2008 housing bubble. Could they slow it down? Absolutely. What we talked about at the beginning of this video, they're backing bigger and bigger mortgages here. So they're really trying to fight against this home price deflation or falling prices, that's for sure. And for a little bit of context on this, let's go over to this chart here. This is out of MBA and the Mortgage Bankers Association. What do we see here? We see mortgage delinquency rate. And let's take a look right here where my cursor is. This is 2020. Now, the orange line is the unemployment rate. Of course, that spiked up temporarily. But look at the mortgage delinquency rate. It actually spiked up to about over 8%, about 8.5%. And that was alarming at that time. But then what did they do? They came in with all these rescue programs and they canceled foreclosures basically. And what did that do? That kept the delinquencies from spiking, because you can't have delinquency spike if you cancel foreclosures. So there's no such thing as delinquencies for a point or for a period. Now, we finally came off of that for the most part. There are still some cities under that emergency rescue. But look, it spiked up over 8%. Go back to 2007, 8, 9, the housing crisis or the housing bust and the financial crisis. And we were just about 10% there. So we were over 8% here in 2020. And at the worst, mortgage delinquencies were at 10% during the housing crash, 2007, 2008, 2009. So that tells us that there would have been a major housing crash if it were not for the intervention that we saw back in 2020 with all those rescue programs. Now, let's make it clear here, and this is my opinion. I think rate cuts are going to be too little, too late at this point. What good are rate cuts when Americans are either maxed out or close to being maxed out, under record levels of debt? It's going to be too little, too late, because rate cuts don't erase the debt. The only thing that erases the debt is forgiveness or bankruptcy. And we're likely to see a lot of bankruptcy. Now, what could they do? They could come in and say no one's credit score is going to drop even if they file bankruptcy, and therefore everybody's credit score stays good enough to go out and get more loans even after bankruptcy. They could do something like that. I wouldn't take anything off the table at this point. Look at what happened in 2020. We should have saw a housing correction, just like we proved in that previous chart there, where delinquencies were up to 8%, and at the peak was only 10%. So we were right there. We were going to have a massive housing correction, but they didn't let it happen. The powers that be, they can completely change the course of the economy and what happens with the cost of living. So ask yourself, if they did want the cost of living to come down, aka inflation, what most people consider inflation is their cost of living, if they wanted that to come down, why are we backing bigger mortgages? Why are we talking about rate cuts? Why do we have endless rescue programs? And if you look at rescue programs, also the bank bailout, they're not calling it a bailout, but it's still happening right now. We still have this emergency funding program in place ever since March of this year. That's still going on, right? So we don't have anything close to a free market, folks. This is all controlled, manipulated. They don't want the cost of living to come down. They would rather have inflation versus deflation. So they're talking a good game. They're saying they want to fight against inflation to make people think they're trying to do something to help people, but are they really doing anything? So what they're saying and what they're doing, it's two opposite things. Yes, they're raising rates. You could say they are doing that. Could be worse, right? So I guess if you want to do the positive picture, paint the positive side of this, or look at the sunny side, is that it could be worse. They could have left rates at near zero, and we would see home prices probably would be, who knows, 20, 30, 40% higher than they are right now. So at least we are seeing some sort of, I don't want to say a fight, but some sort of movement or some sort of effort. But it's not going to be enough for people that are suffering under the cost of living right now. So, and why do I keep coming back to this regarding the consumer and the savings rate and the delinquency rate, is because the consumer is the driver of the economy for the most part. Now, you have government spending out there, other things here that get chalked up as gross domestic product, which gets put into the economic numbers, GDP. And when the government spends money, that's GDP. And look at what we're doing now. We're spending money, what, $1 trillion in new debt. What did it take? 3 months in the national debt? I think we're just at about $34 trillion right now. And, no sign of stopping that. So when they say they're fighting against inflation, you have to look at the big picture, folks. The housing bubble was canceled, or the housing crash, I should say, was canceled. Unless something else big drops or prevents banks from loaning out money, bigger loans, more rescue programs, and home prices, yes, they're going to come down, but it's not going to be the crash that a lot of people had hoped for and predicted, all right? So let me know what you think about this report today. We're going to wrap it up here. Please give us a like if you like what we talk about here, and you can help keep this channel alive. Thanks, everybody, so much for being here. Keep stacking, everybody. We'll talk to you very soon, maybe tomorrow. Bye now. Peace.